Hello, I'm Greg Hunter. Thank you for joining USAWatchdog.com. With me now, Carl Denninger at market-ticker.org. Mr. Denninger is a professional trader. He's written hundreds, if not thousands, of articles on his market-ticker-org website. And, Mr. Denninger, I interviewed you, 6 weeks ago, a couple of months ago, and you made a pretty bold prediction, and that was you thought it would all blow up before the elections. And I'm smiling because every week you look more and more correct. What do you say now?
Well, I say that the math always wins. It's, 2 plus 2 is still 4, despite the attempts of central banks and governments to claim that it's 6. And we are at the point where there's just no more money. And so what we have seen now is the furious attempt to deny the fact that you have a bunch of governments and other institutions that are bankrupt, just like we had happen in 2007 and 2008. And it's going to play out the same way. We're in this end period here where the market is still staying relatively buoyant because it thinks that there is some solution that's going to come from some kind of political process. And the latest is that now we have everybody saying that Europe must take all of the debts within Europe and put them all on everybody's balance sheet in order to maintain this illusion of solvency.
But the fact of the matter is, right?
Yeah, well, Angela Merkel has said nuts to that, and so have the rest of the German people, and with good cause. Yeah, the Greek elections unlikely to lead to a coalition from a government formation. That's just because, regardless of the polls and the actual results, you need to have 50%, and that would mean that you would have to be able to form a coalition with other groups. It's a parliamentary system which the United States is not terribly familiar with. So what you're likely to have here in the coming weeks is yet another set of elections that get scheduled, and then the big problem is they're just going to run out of money. And so you go back to the
well. What happens with the Greek elections? What government is formed out of all this? It just comes down to a math problem, does it not?
It's always been a math problem. We have in Spain a property bubble that burst. You have banks throughout the European zone that created credit with no collateral behind it. And now the people who actually have money in the system are saying, you know what, you guys are broke, so we're going to take our deposits and we're going to withdraw them and move them somewhere where they're not broke. That's a bank run. And
what we're having is an electronic bank run in Spain and Italy and back to Greece. These are all countries that people are trying to pull money out. We've had a bank holiday, at least with one bank
right.
in Italy, where they are, have capital controls. They're limiting your ATM withdrawals. They're limiting capital across borders. This looks like desperation to me.
It is desperation, and unfortunately, this is the same sort of thing that set off the crisis back in 2008. We had the same kind of situation arise. Bernanke disclosed that $500 billion was pulled out of U.S. funds and wire transfers in the space of a couple of hours. There are reports that $1 billion a day in euros are going out of Greek banks. This cannot be maintained for any kind of material, period. And unfortunately, confidence is born out of one of two things. Either the knowledge that you are actually solvent because your assets are greater than your liabilities, or people believe the lie that you are solvent when you really are not. And what we're doing now is playing the second game, which is lying about the solvency of these institutions as opposed to trading on the actual solvency of institutions. This is doomed to fail. And so at the end of the day, somebody has to take the loss. And we did not learn the lessons of 2008. Which are that insolvent institutions cannot be propped up indefinitely. Somebody has to eventually take the loss. The loss itself occurred when the bad loan was made. It didn't occur later on. It occurred when you made the bad lending decision. So all we are now trying to determine is how to allocate those losses. And so far within Europe, the answer is we're not going to allow the people responsible to take them. It's the same problem we had here, which went on right up until Lehman blew up.
So we're talking about a big G20 money bomb now. A big coordinated bazooka or howitzer or, a nuclear money bomb drop from the G20.
Well, where are they going to get it from?
I mean, they're going to print it.
Well, that doesn't do any good. See, this is the conundrum that everybody has run for the last several years. All right, we're now 5 years into this. This started in 2007. And the answer always was, from all of the policy wonks, well, they can print money. They can't go bankrupt because they can print money. Okay, this was what was said about the Fed. This was what was said about the ECB. At the end of the day, the ECB can print money. The problem with doing it is that when you do that, you decrease the value of every unit of money and credit that's in the system now. So you raise the price, the cost of every common person's necessities of life. Well, when they go broke, have you accomplished anything? Essentially, what you have done is put a backdoor tax onto the population and into the economy. Yeah. You didn't do it by raising taxes. You did it through the back door. But economically, its impact is exactly identical to raising taxes. Solutions to these problems are political, which is that government cannot spend more than it takes in taxes. That's the bottom line. And until we see recognition of that, this cycle is going to continue. But every time that they do this, every time they do quantitative easing or money printing or whatever have you, or LTROs or all this other stuff, all they're doing is debasing the currency. It is an effective tax increase. It kicks the can further down the road, but makes the actual damage worse. We should have fixed this in 2008. We didn't, and now we're going to pay for it.
Isn't the giant overhang in derivatives, and some people say it's a quadrillion, 4 or 2 quadrillion. Let's just use the Bank of International Settlements number, 700 plus trillion in derivatives. JP Morgan has 70 trillion, a tenth of the stated derivative amount in the world. He was in front of the Senate last week, and of course, hey, King Jamie Dimon, nobody lays a glove on him. And I think I know the reason why. The banks are powerful, and these people want to be reelected. And B, I think everybody on both sides of the aisle, Democrat and Republican, know that people like J.P. Morgan are using interest rate swaps to hold down interest rates, and they want that game to continue. And that's why they don't prosecute any of these big banks. That's why they don't break them up. That's why they allow them to trade in derivatives, because they need that to happen. I mean, they have FDIC insurance. Jamie Dimon says, so here's my question. So Jamie Dimon says that we're better off than we were before. Of course, two giant missing answers for 2 giant questions is, how big are your losses? He won't say. How big is the trade? Kay Hagan asked that. And he said, oh, no, I can't. No, that's a proprietary, basically. So my question is the financial system, because of all these derivatives, is it better off today than it was in 2007 or 8?
No. It's not any worse off. It's in exactly the same place it was in 2007 and 2008. It's insolvent. It's been functionally insolvent for more than a decade. And the bubble that was blown in the housing market, you can see it in the credit and GDP growth numbers, is just pure unbacked credit emission. You can get away with this right up until somebody stands up and says, give me back my cash. I don't believe you. You're lying. And then the run starts. And that's what we have now. We have a liquidation event. And all of the people who told these lies are shown to be liars. Can you stop it? Well, temporarily, sure, if you can manage to restore confidence that people really aren't bankrupt. The irony of this is that J.P. Morgan is perhaps the only one of the major institutions that has international exposure that might actually survive an unwind. But I can't tell you that with certainty because I can't see inside. Jamie Dimon refused to answer this question. Well, the problem is without the answers to these questions, how big is the trade? Exactly what is it? Where is it? What's the embedded loss in it? I can't tell you whether or not he can get out of it or not.
Where are you putting your money? I mean, it just sounds like a completely crazy, dangerous financial system. Am I wrong?
No, you're right. The thing that you have to look at is there's 2 possible outcomes that come from this kind of an event, okay? The first is that credit deflates because it has to, because people cannot pay. And when they can't pay, that's a deflationary event. As credit deflates, nominal prices go down. This is what Bernanke is all worried about. This is the deflation boogie monster, okay? And all you have to do is look for times when credit is increasing at a lower rate than GDP, or when GDP is going down, credit's going down faster. That's that monster that he's so fearful of. And the reason is because when that happens, the Ponzi scheme becomes exposed. People can only actually cover things that they have assets behind. Well, if your assets are denominated in debt because people have borrowed against them, now you've got a problem. You've got a spiral that feeds on itself. But either that is allowed to occur at some point because they can't continue to blow this bubble any longer, or you have a hyperinflationary kind of explosion. In a hyperinflationary kind of explosion, absolutely nothing is safe. You may as well own land goats, cows, and the means to farm them, because that's the only thing that's going to have value. Okay? In a deflationary situation, you want to hold capital, because you'll be able to buy things for pennies on the dollar. This opportunity has already come up to a limited extent. In certain parts of the country, you've been able to pick up real estate for literal pennies. And over long periods of time, that can be very profitable. It's not get rich fast. But at this point, it's about preservation of capital. It's not so much, you trade markets as an active trader if you can do that. But most people have to go to work. They have a job, okay? When you have the kind of volatility that we have going on now, being an active trader, unless this is what you do for a living, is crazy. You're far better off to be out of this. Get as far away from it as you can.
Okay, wrapping up the interview here, where do you see the rest of 2012? You think it still blows sky high before the election? And what does the rest of 2012 and 13 look like?
I think the rest of 2012 is going to be very volatile, but it will detonate before the election comes. I expect a very serious sell-off, not the kind of little thing that we've had so far, something much worse, a more akin to 2008 style collapse.
50%. Oof.
Very, very possible, yes. Although it's also possible that instead of a crash, we get a grind lower that just never seems to end, okay, and goes on for a year or two. Look at what happened with the Nikkei. It's trading in the 8,000s right now. It was at 40,000 years ago. It's never come back. That's the kind of endpoint that I see this eventually going to. And I don't see the real economy recovering either in 12 or in 13. And my suspicion is you're going to start to see the layoff numbers come back up again, right into the maw of the election, which is Obama's worst nightmare.
And so 2013, 14, when do you think we're through the woods? I mean, before we have some type of event that, okay, this is it, game's up, jig's up, things are over, going to have some bankruptcies, going to write down debt. When does everything get finished? To 2015, 16, 17?
When they stop screwing around and accept what has to happen.
Which is bankruptcy, basically.
Which is bankruptcy of the institutions that are in fact bankrupt. It is the write-downs and the cram-downs that have to take place throughout the capital structure. It is protecting only depositors and letting all of the other chips fall where they may. And it is dealing with the fact that we've made promises in pension funds, retirements, annuities, insurance companies that we cannot keep. And until we tell the truth about this and put these institutions right so that they are solvent on an ongoing basis, we're not going to see the end of this.
The bankers are going to fight this tooth and nail.
You bet. Yes, they are.
And so what does that mean? What does their fighting mean? More money printing, more lies, more phony accounting? Is that what we're looking at?
They'll try right up until the point that the people say we've had enough. Okay, you look at what's going on over in Greece. The bankers got all of the money from the bailouts. The people got none of it. Okay? At some point, the people revolt. They say, we're not going to do this anymore. That's what's going to eventually sweep through the world, and that's when it stops.
How about the U.S.? I mean, aren't we the biggest debtor and the biggest risk to the global economy when the Treasury market and people say, yeah, we don't want any of your treasuries?
If that happens, then you're looking at an instantaneous 50 to 75% cut in the size of the federal budget and a 40 to 50% contraction in GDP.
Whew.
So let's put it this way. The people in D.C. had better wake up and cut it out, because if they don't, that's what's coming.
Carl Denninger, market-ticker.org. Thank you for being on USAWatchdog.com.
Thank you.